Hey, everybody. Thanks for tuning in to our Master the Market segment. So, boy, last week was something. Things were going along nice and quietly. Bond market and interest rates kind of moving sideways, digesting those wonderful gains we had over the last few days until we got to Thursday. Last Thursday, we had an auction. And remember, if you recall our last video, we talked about how, will the bond market be able to absorb all this new supply that's come to the market, all this deficit spending? Well, on Thursday it didn't go well, right? The 30-year bond auction was a dog. Why? Because the Treasury Department had to issue more yield to get people to buy the bonds, and that should be a concern for us on a going forward basis. But if that were not enough, Fed Chair Powell came out and essentially said, "We're not sure if we've gotten to a restrictive policy yet, leaving the door open for more rate hikes." So, that was kind of like what capped off the week. But another thing that we're watching carefully as we look at this week are interest rate levels, right? 4.5% in the 10-year note is a clear floor of yield support. That is something that in order for rates, home loan rates, to get any more improvement, we need to get through 4.5%. So what could do it? Well, this week we have inflation numbers, right? We have CPI and PPI, the Consumer Price Index. If it finally shows that some of the labor market, some of the shelter component is starting to decline, if that number comes in lower than and cooler than expectations, I think the bond market can blast off. The opposite is true. And what would make this happen? What is also driving the volatility? The short sellers. Remember, there are a lot of folks betting on higher rates. We have to watch that carefully. I hope this finds you well. Have a terrific week, and we'll talk to you soon. Bye for now.
For more on these and all of today's top stories, go to nationalmortgageprofessional.com.